Oh, hello everyone. It's Susie, Crypto Granny here. Another word of the day, and we're going to continue doing word of the days. There's so many different things that people don't know in the market that we look at in terms of risk metrics. And it's really important for your learning because we look at so many things in a day to decide whether we're going to get long or short the market or whatever. Sorry, it's early here today and I haven't had my second cup of coffee yet, so I still sound like I'm half asleep. Just bear with me for a minute. I hope you're all well too. Very well indeed. Big day today. The FOMC meeting is out. It is, what time is it? It's 2 o'clock. Oh, I always forget the time difference. It's 2 o'clock American time today, or 6 p.m. UTC time. Now, the thing is, a lot of the market thinks the Fed is going to raise rates by 25 basis points. Today, I don't believe they should, simply because we saw massive contagion in financial markets. And seeing this sort of contagion is seriously bad. Seeing contagion in the financial markets, we saw 3 banks in the US go down the gurgler, simply because there was a run on bank deposits. When the bank has a run on its own deposits from clients, which is their liability, the bank's liability, they have to pay clients back. Often it depends on where those deposits are sitting, with their bought assets with those deposits or lent them out, for mortgages or whatever. They have to liquidate money fast. And often when they have to do that, they actually lose money in a rate rising environment, okay? So if you buy bonds at a lower level in terms of interest rates, say bonds at 4%, and the next minute they're at 4.5%, and you have to liquidate, sell those bonds to get cash to pay your liabilities, which are client deposits, you actually take a loss, and it makes it even worse if there's a real run on the bank. So the Fed had to come in and put in $300 billion into the financial markets, support many banks in terms of the FDIC scheme, the deposit scheme, $250,000, and they're thinking about increasing that. So today's going to be very interesting. The FOMC meeting at 2 o'clock. Jeremy Powell will talk at 2:30. It's going to be very interesting. I believe they will not rate rise. They shouldn't be. You cannot have this sort of contagion in markets. When you see this sort of contagion, it can happen quick. And these banks went down within 2 days, 48 hours. Like, I've never seen it so fast in my whole life. Even in 87, it took a week, or two. And in 2008, it took about a week. But now it takes about a day or so, and that's it, right? So pretty scary stuff. Now, the word of the day today is the ICE BofAML Move Index. It's a big one. A lot of people don't know about this index. It's a fixed interest index. It's a really important one. Often the fixed interest market starts to see risk before any other market does, okay? We really do, because it's all about cash and funding. Excuse me. So what is this index? There's my disclaimer. This is education only, not financial advice. It's education, teaching about an index. So what is this index? Let's just have a look. BofAML Move Index. And it's a fixed interest index. It measures the volatility in US Treasury bonds, and it looks at, and it uses it as benchmark for interest rate derivatives as well. But it's a volatility that's measured by the Black-Scholes model for options modeling, and it's on 1-month Treasury options as well as many other Treasury options. Now, this index, it can be tracked real time on various websites: Yahoo Finance, FT.com, investing.com, CNBC. These web prices provide the index opening, daily range, and closing price, and its performance over time, right? Now, the higher this index gets, the more volatility in the fixed interest markets, okay? It's a very important index because it measures volatility in the fixed income market, and it basically is a intraday index, and it keeps moving, okay? And everyone looks at this market, particularly if they are fixed interest traders or money market traders and that sort of thing. So let's talk about this index. The index currently was at a 182.64. It is at its extreme. There's no doubt about that. From its mean price, which was around, say, 90, somewhere like that, or 120-ish. Basically, it is significant, this index, because it shows you how bad the volatility is getting within fixed interest markets. And as markets become less liquid, this index will go higher and higher. And that's pretty much what we've seen over time. Last week, the week before, you can see this index was down below 100, and now all of a sudden it blew up to 200, and currently it's at 182.64. This index is very useful for traders and investors because it tells us what the market is thinking, okay? If this index goes higher and there's more volatility, it tells you there's going to be a move in interest rates, and that's pretty much what we've seen all year. When we go back to here, February-ish or mid-January, the index was under 100, and we've seen this massive move up in the space of 3 months, which is a massive move, okay? This index alone will tell you that volatility is increasing in fixed interest rate markets, ACA/interest rate markets, and you know a big move is coming in a rate change, right? Just because of this index. It's one of the tools we use. We use many, many other tools, people, okay? So I need you to know that. So the index represents the percentage value in the price of a 1-month treasury option that will result from a 100% basis point move in yield. Now, this is huge move, okay? Absolutely huge. If you have a look at this, 182.64 was a day ago. It represented it was up 26% from the previous close. The overall range of this has been 91.76 to 198.71, nearly 200. And that move up from mid-January is massive, okay? Under 100, and it got to 200. It's a massive, massive move, over 100%. And you know something is coming. This is one of the indexes that we monitor all the time, okay? Also, it gives you an expectation of market moves in interest rates and futures and derivatives, okay? So again, the volatility as it gets worse and worse in treasury bonds. In other words, the price range, the true range gets even worse, and implied volatility gets higher, that index will go higher and higher. They can also calculate this index on not only the 1 month optionality of fixed income, but also 2 years, 5 years, 10-year, and the 30-year bond as well. So you can have a combination of these indexes on different bonds as well, right? How is this calculated? Well, looks at over-the-counter options on the US Treasury market, generally with maturities of 2, 5, 10, and 30 years, but it also looks at the shorter dated ones as well, and even the Treasury bonds with a maturity of less than 30 days, okay? It is a complex mathematical formula, which we won't go into here. It does include the price of options, time, maturity, strike prices. It also includes volatility and interest rates. So as interest rates go up, that index volatility goes up as well to the underlying asset. And it's annualized on a 30-day basis, okay? The method, if you really want to get into the calculation of the method, you can look it up on the ICD Data Index website, and they're responsible for publishing this index and making sure this index is right. But certainly investors should be aware of this index and understand the methodology of how this index is calculated, so they know exactly what they're looking at. The bottom line is that this index moves higher, it means there's more risk and volatility in fixed interest markets, interest rate markets, and you know you're going to get a big move if it goes up by 200%, like we've seen from January. Now, if you annualize that 200% from January to March, it's actually, you multiply that by 4, that index is up over 800% just from the move of January, okay? And that is massive. An 800% move in this index since January is absolutely massive. And that shows you that the Fed has been raising rates very, very quickly. And the reality is the Fed have been raising rates too much, too quickly. And now we're seeing contagion in markets where there's a funding problem and a liquidity problem because people are trying to find cash and they can't find cash fast enough for when there's a run on a bank and they have to pay back their clients' deposits, okay? And that's what it comes down to. Contagion is a bad thing. If you start contagion in these financial markets, they're all connected by cash, you're going to have all markets collapse. And that's something the Fed doesn't want, seriously. They've been so stupid about keeping inflation down, but it doesn't keep inflation down. Raising interest rates makes inflation go up higher, and it causes contagion in financial markets like we saw last week, okay? We've still got contagion from FTX and everything else, and we're still seeing the dominoes fall in every corporation and some cryptocurrency exchanges and whatnot. So it's not a great story, okay? Not a great story at all. Now, the index, as I said, as the volatility gets higher and higher and more uncertainty in the market, and more expectation of future interest rate movements, this index will blow out substantially, okay? Anything over 100 is a massive move, and we've seen this thing get to 200 in the space of literally about a month, right? And that tells you that risk is increasing in financial markets, right? Risk is increasing. Again, people need to understand this index in terms of fixed income investments. If you buy bonds at 3% and all of a sudden a bond's at 4%, it means the price has gone down, yields have gone up, and whoever holds the bond at 3% has lost 100 basis points on that holding from 3% to 4%, okay? It's not a good story. And combined with this, you can see what's happening with the economic trends and the economic factors within money market and monetary policy changes, but also within the financial markets, okay? This one's a big one, and you need to be aware of this one, right? So, you know, as I said, the components of volatility, interest rates, term to maturity, what else? Volatility, interest rates, term to maturity, the options model, which is gamma, delta. There's a lot of stuff that goes into this, okay? This index was also acquired by Bank of America Merrill Lynch. That's why it's called the BofAML, whatever it's called. But it's a scary moving index when you see it move 800%, okay? So it's certainly the one you need to be aware of. Bank of America Merrill Lynch, BOFA, move index, ICE, very, very important index. There's my disclaimer, everyone. If you have any questions, please do come back to me. Very quickly, the FOMC meeting is the second day today. We will expect a change in interest rates in the afternoon. What is it? It's UTC time, I think, at 4 o'clock or 6 o'clock. I'll certainly come out with that. I'm calling for no change. I think they're mad if they raise interest rates. They are putting money into financial market systems to stop people from falling over, yet every bank that fell over complained about massive hikes in interest rates. And so they were carrying massive losses. And it's been anticipated that in the financial system of the banks within the US, they're all sitting on about $2.2 trillion of bond losses because interest rates have gone up and up and up. So anyway, guys and girls, there's the disclaimer. It's education only. If you have any questions, please do come back to me. And thank you very much for listening. And today is a very exciting day because if they don't rate hike, this market will go through the roof. This crypto market, I believe even if they do 25 basis points, the market will come off a little bit, but I do believe people will buy crypto simply because people are not long crypto. They've been killed in the last 4 months. I've been ultra bullish since January, and I believe we're going to have a huge run in crypto this year. Prices high. There is no supply of Bitcoin, and people keep selling Bitcoin and they're mad. Bitcoin, 21 million, 90 million's been mined, a million's been lost. There is no supply. That's why we're seeing the Bitcoin dominance at 45.67. Anyway, guys and girls, that's enough for me. I'll talk to you very soon. Thank you. Today, particularly because of the FOMC meeting. So I'll come back to you about that, the outcome of that. Thanks very much.